These are extraordinary times. To put things in perspective for investors, we are talking to Patrick Yeo, Chief Investment Officer at Fullerton Fund Management. Patrick, what is your outlook for Asian markets?
On Asian credit, we are cautious as market is currently driven by technicals and rising concern on the fundamentals of some high-yield corporates arising from this downturn. We are adopting a more defensive strategy at this juncture, with preference for investment grade, although there are pockets of opportunity within high yield. Chinese property high yield is the preferred segment, as we expect the stabilization of COVID-19 situation in China will bring about the resumption of economic and business activity. On Asian equity, we are cautious in the near term, but very constructive over the medium term. Within Asia, China is supported by recovery in domestic demand and a strong fiscal impulse. Export-dependent markets are vulnerable to an earnings slump caused by a US recession. While ASEAN and India, they are still struggling to control the outbreak, and hence domestic demand in these countries will be weak in the coming months. Earnings have not been sufficiently downgraded given the recession of the first half of this year. Risk to earnings across Asia is skewed to more downgrades to consensus forecasts for 2020. So while valuation in Asia appear attractive at -1 standard deviation versus 5-year mean, if we adjust for earnings downgrade that we expect, valuations are at best only reasonable after factoring the slow recovery and higher risk premium, and these are in the near term.
The situation is so fluid. Under what circumstances would you review your investment thesis?
It's a pandemic, and the containment of the outbreak is key. It will be largely dependent on the magnitude and duration of the COVID-19 situation, and how quickly can global economic or business activity resumes. A positive scenario is successful containment in this quarter and a V-shaped economic recovery in the second half of this year. For investors, it comes down to having an accurate assessment of when markets have more than priced in the worst-case scenario. That will be the time to increase risk assets. Currently, we need to focus on high-quality companies with strong balance sheets, diversify the portfolio across different alpha drivers, and thirdly, think of new growth opportunities in the post-COVID-19 world and invest in this on appropriate valuations.
Closer to home, to what extent can the stimulus package announced in Singapore cushion the fallout for the economy?
The amount of fiscal support totals 59.9 billion, a very large 12% of GDP, with 21 billion coming from the reserves. The policy measures will help to preserve jobs and provide near-term support to businesses and households to prevent permanent damage to the economy. But the recession cannot be averted. And the Ministry of Trade and Industry has recently revised its GDP projection for 2020. It is now from -4% to -1%, from the range of -0.5% to +1.5% earlier in the year. Budget deficit will increase substantially to 44.3 billion or 8.9% of GDP this year. Fiscal policy is expected to undertake most of the heavy lifting. Given our strong reserves position, the government can provide a fourth stimulus package should the condition require.
Fullerton is an active investor in REITs. How do you think this crisis will impact the sector?
Retail REITs are most affected, as the circuit breaker curtailed foot traffic in shopping malls and caused sharp drops in tenant sales. Landlords have to offer rent rebates. The new bill passed recently allows tenants to defer payments of rent for 6 months. It also prevents landlords from terminating a lease or taking legal action. This means lower cash flow and potential collection issues. Dividend payouts will be affected in the coming quarters. It is not all doom and gloom, however. So compared to the GFC, the REITs now have lower gearing ratio, ample credit lines, and better debt maturity profile to withstand this downturn. Bright spots within the REITs space include logistics and data center. Tenants here are seeing increasing demand from accelerated adoption of e-commerce and cloud computing. The moderation in valuation can provide an interesting entry point for longer-term investors.